Welcome back. Thank you for tuning in to our next episode of the Virtual Heart of the Business Conference. I'm Tom Jacobs, and along with my co-producers, Rita Hernandez-Figge, Jake Bartelt, and the rest of the team at MedHQ, we thank you for watching the Virtual Heart of the Business Conference. We're joined by John Page, our host and discussion moderator, as well as today, our special guest, John Nowicki, the president of LCM Capital Management. The purpose of the Heart of the Business Conference is to gather together people who are interested in the topics around wellness and well-being. That is, well-being for individuals as well as for the companies and organizations for which we work. As part of our Heart of the Business Conference series, we're collecting donations on behalf of the Metro Chicago Heart Walk. Thank you for your donations, and thank you for watching this episode of the Virtual Heart of the Business Conference. All proceeds collected from you, and we mean all proceeds collected, will be delivered directly to the Metro Chicago Heart Walk, which is an event created by the American Heart Association to attract community involvement and financial support for the AHA. In fact, MedHQ is also donating to the Heart Walk through 100% matching contributions, dollar for dollar. We're also fortunate to have many wonderful sponsors supporting our efforts and those of the Metro Chicago Heart Walk. Today, I'm going to thank John Nowicki and LCM Capital Management for not only being our guest today, but also for their financial support. In today's episode, our host, John Page, will, along with John, discuss financial wellness. Now, John and LCM Capital Management are the financial advisors for our 401k plan, and we know what a great job they do. So with all that said, John, please take it away.
I'm John Page, here today with John Nowicki. John is the CEO of LCM Capital Management here in Chicago. LCM handles all of the 401k accounts for MedHQ and their employees. So welcome, John.
Thank you, John. Happy to be here.
Good day. The pandemic has played havoc with the stock market, and I think today, as we talk, the market is up over 50% over the last 3 months. Been sort of a roller coaster ride, don't you think?
Yeah, absolutely incredible. It has been a heart-wrenching and an emotional roller coaster, to say the least, for investors around the world.
What do you think that impact has been on people's 401ks? Are we back to where we were 5 months ago?
Well, yes, the short answer is the markets are, which is incredible. I think it's also testament to how people should be investing. You know, there's a cliche in this industry, it's time in the market, not timing the market. And I think what happened was, in this most recent correction and recovery, it really set the stage and reiterated why that can be the case. I get it. If you can time it correctly, you would have made a fortune. The problem is no one saw this coming. And then if you reacted incorrectly, and now this recovery, you're probably having questions of, do I get back in? Is this now the time to do it? And so I think, especially in the world of 401ks, John, it's important that you continue to just do what you're doing, right? We use a phrase, set it and forget it. So every month you're making these contributions. And so think about this. When this market was going down in February and March, you're making those contributions. You're buying things with the same amount of money. You're buying more of them, right? And now it's gone up. And so you have more. And yes, are you buying it now higher? Yes, but you're buying less of it with the same amount of money. So I think people would be shocked to see how well their 401k is doing. And in most instances, there's a company match that goes along with it, which is clearly free money. And everyone I know that I've ever met in my 32 years loves free money. And so that's a good part of it. So I'd say, yeah, I think people would be pleasantly surprised to see how well they're doing. and it's probably hard for people not to be looking, but we also tell people you probably shouldn't look, because in February and March, if you were looking, you're probably wondering why I'm doing this. But now take a look, take a peek now, and then turn the computer off and go back to work.
What do you say to people that are not investing, that are not putting away money for their retirement?
Well, they need to be, right? I mean, there's plenty of statistics out there, and that's what we lean on a lot for our clients in looking back. Obviously, history is an indicator of the future, but it doesn't tell you what's going to happen in the future. You have to start doing this, and you have to start early, and you have to start often. I always tell a story about my children. I have 4 children. The last one just graduated this last May, but the 3 older boys, we put all our kids on the hook for money for college, whether they take a loan, whether they have to work. They have to have some skin in the game. My present to them upon graduation is I'm going to pay off their debt for them. But with their loan payments, what they have to do is they have to double the amount of their loan payment and put it into their 401k plan. Now, having this conversation with a 23-year-old or 24-year-old who's more worried about a 6-pack of beer or a 30-rack of Busch Light, right? Thinking, wait, what do I need this for? I've got plenty of time. My wife's screaming at me, Maria, she's going, John, you're scaring the kids. And I'm like, no, I'm preparing the kids. And now I look at them and, 28, 27, and 26 years old, they have more money than I have saved. And it's that power of compounding, right? It's putting the money in early and having your money work for you every single month, every single year. And you look at it, and it doesn't have to grow a lot, but that power of time and money is incredible. So especially in today's day and age where the world is scary. I mean, there are a lot of unemployed people. People are panicking, and no one knows what the future holds. So it's going to be up to us to help our retirement plan, our retirement, and to have that planning, because of the fact that Social Security probably is going to be around, but maybe not to any extent that people expect in the future. So it's really going to be up to us.
Not something that you can live on. I mean,
yeah, absolutely not. John, I think I read somewhere my number is going to be off slightly, but the average person is going to receive $1,600 or $1,200 a month, some amount of money like that from Social Security. So extrapolate that out. That's $14,000, $15,000 a year from Social Security per person. No one can live off of that. So it's really going to be up to us to do it, and especially MedHQ. And look, and I'm biased because I love the company, and we've done unbelievable work together with them for this 401k plan. The fact that these smaller entities, these smaller centers have plans, have matches, is a gift. And people need to be taking advantage of it and doing it as much as they can.
I know when I was the CEO, we had a pretty nice match, and I had a very difficult time getting younger people to understand what you just said, because they were, in fact, looking at money today. If I have an extra $50 this month, why put it in something that I'm never going to see?
Right.
And as much as I tried to encourage them, to do that, we couldn't do that. How do you justify not participating in a 401k match when you've got a fairly generous program?
Yeah, well, I mean, I like to scare people is what I like to do, right? So you look at what we do on the outside of the 401k plan, so managing clients' assets. And typically what people want to do is they want to have that serious meeting with you, that serious financial planning meeting at age 65. And they're like, okay, I'm ready to retire. I need help. Okay, what do you got? And it's like, no, I see that, but what else do you got, right? And so, I say this, and it's in jest, of course, but it's, we say, repeat after me, welcome to Walmart, because you're going to be working at Walmart as a greeter, because of what you didn't do back when you were younger. And look, if you can, I mean, obviously there's people that are going to be watching this that aren't 25, but it's never too late to start. But if you can start early, it's going to make a big difference. And with that match, I mean, the problem that we've seen, and it's again, it's statistics, and most people will only contribute up to the match, right? So if a company's contributing 3%, they're going to contribute 3%. I get it, but that's a mistake, because if you contribute 5%, if you contribute 10%, they're going to still give you 3%, which means you're making 30% on your money if you're contributing 10%. You can't get that return anywhere. It doesn't exist. And so you should do that. And so one of the things that we tell people, right, everybody has a New Year's resolution. Well, I think most people make them. The problem is no one really keeps them. You know, what we tell people, you go to the health club in January, pre-COVID, of course, and you can't get on a machine anywhere. February, a little less. By March, it's a ghost town. It's back to normal, right? So here's your New Year's resolution. Every year, you resolve to increase your 401k contribution by 1%. If you do that, you can brag to everybody that you have a New Year's resolution that you keep. It's really good for you, and you'd be absolutely shocked at the increase. And to think about this, if you're at 3% and you start and you go to 4%, you've just increased your retirement savings by 30%. And if you go from 4 to 5, you've just added 25% more to your savings.
And that compounding year over year is bigger and bigger and bigger.
It's unbelievable. And before you know it, right, I mean, because not everyone, John, can just go, I'm going to start with 15% and go, right? I mean, that's what they say the number you should strive to for younger people. But we tell people, you know, get to a number in your mind that you think you'll notice in your paycheck. So whatever that threshold is, if it's a flat dollar amount or a percent, put that dollar amount in, because the reality of it is if you don't notice it out of your check, you probably should be contributing more. And if you notice it out of your check, you're probably going to run down the hall to the HR department and say, wait a minute, save a little less. That's great. But the chances of you running down to HR and saying, I'm not saving enough, do this, is slim to none. So we tell people, whatever that number is in your mind that you think you may notice, do it. After a couple months, you won't even know it's coming out. And so January 1st happens, New Year's resolution, boom, bump it up. You will be so, so grateful that you will. We're talking about financial wellness. That's gonna make you well.
Is my contribution pre-tax or post-tax?
Well, it depends what you're going to do, right? So there's two different options. There's the traditional 401k plan, pre-tax, and then there's the Roth, which is the after-tax. And so basically the difference is, for people that don't know, if you're putting in that money pre-tax, the government says at age 72, you're going to have to start taking money out of that retirement plan so we can finally tax it. The Roth is just the opposite. Because the money's going in today pre-tax, there's no requirement for you to take that money out at age 72. And if you take it out, it won't be taxed because you've already been taxed on. Now, the question we get is, which is best? Now, again, if you have the answer, let me know, but I've yet to find anyone that does. Because at age 72, whether you're 50 or 25 or 40, what is your tax rate going to be at age 72, right? Nobody knows that answer. So that's why there's nothing set in stone that says I have to do the Roth, which is the after tax, or I have to do the 401k plan pre-tax. There's no right or wrong answer. It's really up to yourself. You can split them to kind of hedge yourself and put one in both. The requirements in terms of how much you can contribute stays the same. But if you're worried about playing this tax game, maybe you do a little bit of pre-tax and maybe you do a little bit of post-tax. Personally, what I do for myself is I do pre-tax only because I know the benefit I'm receiving today. I know my tax rate. I know the savings I'm getting. And at age 72, I'll deal with the taxes. Then, in theory, you're supposed to be making less money when you retire, so your tax rate should be lower. The problem is not to be a doom and gloomer, but you've just got a tremendous amount of debt out there in the world, and it's really hard for me to think that tax rates aren't going to continue to go up. And who knows what? There's nothing off the table. Let's put it that way. There's money in Roths. Who knows if the government says, oh, let's just start taxing Roths if you have X amount in. So the way to hedge it is to do a little bit of both. Does that make sense?
I can have both. As an employee, I can have an employer matched 401k and have my own Roth IRA or straight IRA.
You can, but you can't deduct if you're contributing to your 401k plan, right? If you're doing that, you can't contribute. But a lot of plans, and MedHQ does, a lot of these plans offer both PreTax and Roth. And so that's a simple solution to say, I'll split it 50-50 right in between them. And that way I'm good either way.
Where do I have to go to find out my options if I haven't been contributing and now want to think about getting my fiscal health, not just my physical health, back in order?
Well, I mean, there's several ways to do it, right? You can contact MedHQ or your HR representative at the surgery center or one of the other companies that in the healthcare industry. So if you contact your HR person and ask them you want to start contributing into the 401k, they're going to put you in touch, in this case, with me. And they're going to send an email to me and with you included and saying, John Nowicki, LCM Capital Management, is going to help you with their 401k plan. And look, we're all about educating our clients, right? What my industry, and I think I've mentioned this before, John, I've done this for 32 years. What my industry doesn't like is an educated consumer, because then they start asking questions, right? So we want you to be educated. We want you to understand the fees. We want you to understand the compounding of interest. We want you to understand the different investment choices that are available. You need to understand these things. It's crazy because I feel like a politician kind of getting off track here. The answer, but when you look at a mortgage, right? People have mortgage and you ask them what you spend in a mortgage, they're going to give you that number almost to a penny. Yet if you ask them how much it costs to have your money managed, it's a deer in the headlights. No one really knows. But you should know that number, right? Because it's important, because it's coming out of your return every single year. And so you should ask that question. What does it cost me to have my money managed? And what LCM stands for is low cost management. Our belief is that you've got to, we have to charge a fee. But it should be a low fee. And there's three things that affect every investment in the world: fees, inflation, and taxes. Those, no matter what you buy, it affects you. Now, the only one that's uncontrollable is inflation. So we take that out of the equation. The other two, taxes and fees, you have to pay. So fees, you got to pay them. If someone tells you they're doing it for free, run, because there's no such thing as free. And two, you got to pay your taxes. But if you can defer them in the 401k plan, which is a perfect example, I mean, the compounding and not having that money coming out every year in taxes is a massive saving. So if you focus on those two, taxes and fees, you'll be way ahead of the game. And that's what a 401k plan would allow you to do. So I hope that answers kind of the question.
Let's assume I'm for sake of argument, 40-year-old, got three kids. I wish I was a 40-year-old, right?
Me too.
Three kids. You've convinced me I need to look at my 401k. What other things should I be looking at that are beyond the 401k to make sure that my savings is adequate for me to retire and not have to be a Walmart greeter?
Okay, great question. One of the things that we sit down with all of our clients, and I do this personally as well, is look at what you spend on a month-to-month basis, right? It's so important. We get the question asked, how much money do I need to retire on, right? And You're never supposed to answer a question with a question, but we come back and say, well, how much do you want to spend in retirement? You tell me how much you want to spend in retirement. You tell me what your retirement looks like, and I'll tell you how much money you have. But what my wife and I do every year at the end of the year, we go through everything to say, here's what we're spending. So, if you want to email me an expense sheet, or email me, I'll send you our monthly expense sheet. It's a 14, 15-page line item, and you write down everything that you spend. For starters, you should know, and B, you're probably going to get scared because you're going to look at it, right, with the 3 kids. I remember when our kids were younger, haircuts. We would go for haircuts. All of a sudden, it was $50, $60. You didn't think about it. Dry cleaning. I know there's no such thing as dry cleaning anymore, but it's that. Now we have cell phones and cable. So you start writing all of those numbers down and add them up. As my grandma DeVito used to say, Maron, you're going to have a wake-up call and say, wow, this is where our money's going. So by looking at that and seeing what you're spending will be the first step. And then obviously what your after-tax take-home pay is. And for most people, John, there is an amount of money that is unaccounted for. And that's what should be going to your savings. And it's discipline. And as I mentioned about starting a 401k and not contributing 15% to start right away, if that savings is $100 or $200 difference between your take home and what you're spending, just start with $25 or $50. You don't have to start with a lot, but once you start doing, it's like exercising. You don't just run out and go run a marathon. You gradually build up to it. It's the same premise here with savings, but find out what you're spending on a month-to-month basis. And that's a wonderful place to start.
And you can do that too when you get an annual review and say you get a 3% raise. You can take that 1% of that 3% and put it towards your retirement.
Absolutely.
So you don't feel you're still getting a raise,
right,
but you never even felt it because it didn't come out of what you were doing.
Absolutely correct. And most people, most people like the expense of what it costs to have their money managed. Most people don't know what they spend on a month-to-month basis. And so to your point, if you have that number and you know what it is and you have this bonus, you're not even going to know it existed right into the 401k, right into your IRA, and you're going to be thankful that you did. You won't be that greeter at Walmart at age 65.
Let's hope that that's the case, right? Unless you want to. I never
right,
planned to retire.
Absolutely.
I think our generation compared to my parents' generation, retirement is a very different thing. So I may choose to work, but I may have a very different attitude towards work.
No, I would agree with you on that. It is interesting because a lot of people, again, looking at statistics, the thought process is I'm going to work even after retirement or just continue to work. But statistically speaking, that doesn't happen only because of the fact of your health, maybe your spouse's health or family members. I mean, there's a lot of things that obviously will change that perspective. But I agree with you. I think, look, when I was 25, I was going to retire when I was 35 and call it a day. And here I am at 55 working harder than I've ever worked in my life. But I think to your point, and now I think to myself, there's no way I could shut it down. I want to do something in retirement. And I think, things will tell you that you keep that brain working and moving. And so maybe, working at a greeter or Walmart and having that conversation with people every day may not be a bad thing. Just don't be working as hard. And that's the goal.
I know that when we talk about 401ks, we talk a lot about, the equity market, the stock market. Are there other things that I can invest in my 401k? Are there different options? Or do I just have to, you get a 401k, you get this pot, this is what you've got?
Yeah, no, again, a great question. I mean, so there's stocks and there's bonds and there's different types of stocks. There's foreign stocks. So every one of our plans has a list of different investment options, and they run from just a cash money market all the way to a in a international emerging market, which would be considered really aggressive. So there's a laundry list of options that are available. We're big proponents of diversifying and diversifying not just within the stock market, but diversifying within a fixed income market as well too. So bonds, for example, debt of other of companies. This diversification typically allows people to rest easy at night. I mean, yes, if you just bought Apple or just bought Amazon and that's all you ever did, you'd be a really happy person. But the problem is what people don't realize is those stocks do go out of favor. And when they go out of favor, you're not such a happy person. So to be diversified and have those options is important. One of the great things about the MedHQ plan is there are two ways to do it. You can basically do it yourself or have it done for me. And there are models that are set up that are risk-based models. So there are, depending on your appetite for risk, that will just put you in one of these categories to have someone manage it for you, and it's diversified and it's all predicated on your risk. Because John, at the end of the day, that's really what it's about, right? When this market was coming down, if you were taking too much risk, I am sure you got out of the stock market because your appetite wasn't set for it. We don't get a lot of phone calls from clients because we're about managing risk first and foremost. You tell me, and again, we work with a lot of physician surgery centers, it's pain, right? Tell me how much pain you want to endure, and I'll tell you how to manage your assets, how they should be allocated. Not everyone has the same tolerance of pain after surgery. Not everyone has the same tolerance of pain with the stock market. So don't compare yourself to somebody else and see what Susie's doing or what Billy's doing. How much pain do you want to endure? There's a theory that always is you're younger, you should take more risk. You're older, you should be more conservative. We've got a client that's 80 years of age. He drives a motorcycle. This guy wants to go 100 miles an hour. It's crazy, but the book says be conservative, but he wants to go aggressive. Now, our joke is, great, we're going to manage you aggressive, but just do me a favor and let me know when you're on the road so I'm not on the road. But conversely, we have children of clients who the book says they've got all the time in the world, be aggressive, but they don't want to lose a dime, right? So then they should be conservative, and it's okay. If you're lying awake in bed worried about your 401k plan, you're taking too much risk. And look, especially in today's day and age with the market recovering, it's a wonderful time to have that risk adjustment conversation. Take a risk quiz. Again, we have one. We can send it to you, and then figure out what your tolerance for pain is, and then just have that money set that way. And look, to your point before about the 45-year-old with 3 kids, the world's going to change. Having 4 kids, I mean, we were like this, right? We were great. We had money. We had no money. We had, we need to buy another car. We got to buy a bigger car. I mean, it's never ending. So this is never going. This plan that you're going to make. We make an analogy always of a clay pot. If you've ever watched one being made, it's an amazing thing. But we're never going to let that harden, right? It's going to take different shapes and forms, and sometimes we're going to squash it and rebuild it again. So your tolerance for pain is going to change as you evolve in life, but you should have an idea of where it is and make sure today your investments are set up that way.
As an investor with my 401k, should I be having that conversation on an annual basis with your office?
An annual basis wouldn't be a bad thing. I mean, that, the difference is, John, why I hesitate to say it is typically what ends up happening is people want to have that conversation after things go down. Now they want to take a look at it, right? So I put an asterisk by it. Should it be annual? Yes, you should figure out annually, how your tolerance, what your risk tolerance is. But historically speaking, it probably should be done every 3 years, but you can do it every year. Again, I just hedge myself, and only because of the fact that, the rule of thumb is you buy low, sell high. Most people do just the opposite, right? Because when it's going down, it's, get me out of this. I want to get out, and get me into that. Well,
we saw that in March, right? We
I'm
saw
sorry?
that March when so many
Yeah.
people got out of the market at the very
Absolutely.
bottom. You know,
Yep.
they sold their Boeing stock at 89 and now it's, 200.
Yep. Yeah, no, absolutely. And we see it all the time too. So that's why, having that risk tolerance set correctly eliminates when that trough is happening, you're still resting easy at night because you're comfortable losing X percent of money. And so if you can do this annually, great. It's not imperative that it's done annually, but if it's a good reminder to at least, like the New Year's resolution, you can tie it into that and say, okay, I'm going to have my financial wellness checkup. I go to a doctor every year for an annual checkup. Why not have an annual financial checkup too?
Absolutely. If I've never invested in my 401k, never done the match, and I look at all the paperwork and I see all of the options and I'm inundated and I decide I don't know what to do. I feel like an idiot. Is there somebody I can talk to?
You talk to us. This is what we're here for, right? This is what MedHQ has hired us to do, is to help everyone start these plans, stay with these plans, and obviously build on these plans. And so
I can actually talk to a person, John?
You can, believe it or not. Yeah, we're old. You and I are old, so we still like this thing, right? I just found out what Venmo was about a week ago from one of my kids. I'm like, what do you mean you don't have any money?
Yeah, it was probably Venmo me some money, right, Dad?
Yeah, it was a request for money. I'm like, what is this? What are you doing? So I figured out very quickly how that works. But it's really easy. And one of the great things about the MedHQ plan is, it can be done online now to enroll, and it can be done really, really quickly. And so you'd be shocked. I mean, it takes 5 to 10 minutes to do this. And look, everyone has 5 to 10 minutes, especially in today's day and age, to do this. So I would tell you that if you haven't done it, you need to start doing it. And I'm going to scare you because you don't want to have to be that greeter at Walmart. You want that choice to be that greeter at Walmart.
Absolutely. John, it's been great talking to you. Is there one final piece of advice that you'd like to give the folks out in the audience today?
John, I enjoyed the conversation as well too. If my one piece of advice would be, know what you spend to have your money managed. That would be my important piece of advice, because most people don't take the time to figure that out. And it's really an important component because it's your money and you should know what it costs every single year to have it managed.
And you've got a form that I can fill out if I haven't ever done that, haven't ever developed a budget. And I know a lot of people haven't. It's a structured thing that people say, I get a paycheck and I pay my bills and there's nothing left over.
Yep, absolutely. One of the things that we provide all the MedHQ clients, and then it's not a cost to do that, is to take advantage of that. Take advantage of us, take advantage of what we have seen and known for 32 years, and send us an email, and we can have that conversation, and we can run a financial analysis for you, and we don't charge to do it. It's part of the service we provide MedHQ. And everyone should take advantage of it, because you should really know what you're getting into down the road so you can retire and do everything you want to do when you decide to call it quits.
John, it has been a pleasure. Thanks for the great advice. I hope you are inundated with calls after this appears, and make sure that people take advantage of the boom market that's likely to happen. I'm a very big optimist, so I look for opportunities ahead. And
I love it.
I appreciate your time today. John Nowicki, LCM Capital Management here in Chicago. Thanks for your time, John. I'm now on a fiscal path that I want to be in.
Wonderful. I enjoyed it, John. Absolutely. Have a great day.
Be well, John. Thank you.
Take care. You got it. Bye.
Bye-bye.